Since Tesla went public, Musk and his business have unquestionably done incredibly well. Tesla's success has been greatly attributed to Musk. Despite initial skepticism, a growing number of people are already driving electric automobiles. Tesla's growth and stock market performance have greatly benefited from the greater acceptance. Its growth has been so strong that many analysts who had previously opposed the company's shares are now coming around. Jim Cramer is one analyst like this. Jim Cramer, who was once pessimistic about Tesla, is now an optimistic investor. Jim Cramer has revealed the sell-off of Tesla's stock. Jim Cramer switched sides. However, what should, before making a Tesla investment in today's video, let's find out. As Jim pointed out to his Mad Money audience on Monday, things do and can go well occasionally. For this reason, you have to put aside your short-term cynicism in order to make long-term money in investing. Hope springs eternal is a commonly used pejorative term. Nevertheless, the ST500 was able to gain more than 27 last year in spite of a pandemic, problems with the supply chain, and rising inflation. You're seeing that only fools think amazing things happen. Cramer believes that being a money-making idiot is preferable to being a brilliant person who isn't. Stock market investing may need a lot of time at times. Today, we'll look at some data culled from Jim Cramer as we analyze the fundamentals of Tesla shares. Jerome Powell, the chairman of the Federal Reserve, recently brought up the government's bond buying initiative. He'd already said it would be ending after the pandemic passed. However, it appears that he has altered his mind lately. All it took for investors to go into a frenzy was Powell's announcement that the bond buying program will finish sooner than anticipated. Cramer went on to say that considering investors' apprehensions regarding the Omicron model, the timing could not have been worse. What does this mean then for the average investor in index funds? Cramer claims that investors are buying equities with long-term goals in mind. Consequently, the current brief market downturn is nothing more than a chance to buy. He was cautious, though, encouraging viewers to hold out until the first Omicron case was confirmed in the US, which increased sales and signaled a temporary low. Investors can still purchase dividend equities, which will continue to perform well, and technology stocks such as those in Tesla, Microsoft, Amazon, and other companies. Ultimately, it is preferable that the Fed made his intentions known. In the stock market, there are 4 different kinds of sellers, according to Cramer. Fearful of inflation, the first group will seize any chance to scare you away from stocks. Although the second group anticipated a tightening by the Fed, they did not anticipate it happening so rapidly. The third group is merely attempting to secure its earnings in order to repurchase them at a reduced cost. Concerned about an Omicron slowdown is the fourth group. None of these groupings can be entirely correct, which is the problem. The Federal Reserve will not tighten as swiftly if there is a slowdown. If the Fed does tighten, though, it means that conditions are not as bad as people thought, which suggests that buyers will soon be back in the market. Therefore, it makes sense to benefit from the decline. To begin with, the majority of people consider Amazon to be an online retailer. With good reason, it has grown to be the preferred online marketplace for millions of people worldwide. But the business is also involved in 2 other developing sectors that have the potential to generate substantial development over the next 10 years. The 3 high-growth businesses in which the corporation competes are digital advertising, cloud computing, and e-commerce. At $1 trillion, the market capitalization is expected to grow in the coming years. With a 40% market share in the U.S. e-commerce industry, Amazon enjoys a significant competitive edge. Walmart, on the other hand, has a 6.6% market share, which is far higher than that of its nearest rival. Furthermore, Amazon holds a 32% global market share in cloud computing, compared to Microsoft's 20% share. In the last quarter, Oz's operating margin was around 29%, while its North American and foreign e-commerce businesses had operating margins of about 4% and 1%, respectively. This is the growth engine for the company's cash flow. If you own stock in Amazon, you may be worried about the company's negative free cash flow for the previous 12 months. In actuality, cash from operations has decreased by 1.2. Even now, Amazon is making significant investments to grow its fulfillment network. CEO Andy Jassy said in the last quarter that since the outbreak, Amazon had almost tripled the size of its fulfillment network. He thinks that doing this would strengthen their competitive edge and help them provide customers with an amazing delivery experience. On January 25, 2022, Microsoft announced its Q2 financial results. The company brought in $51.07 billion in revenue and made $18.08 billion in net profits. Net income has increased by 21, although revenue has increased by 20. The third quarter revenue rise of Microsoft was attributed to its Windows operating system and Office cloud services. With the exception of devices, server goods, cloud services like Microsoft Azure, and a few other items, almost all segments have showed notable increase when comparing the first quarter and full year fiscal year 2022 and 2021 statistics. Investors will be looking for more advancement in this area. Recently, Microsoft's margins have improved, which is fantastic news for investors. Accountably, the EBITDA margin is now higher than 50. The higher operational income of the intelligent cloud is also responsible for a large portion of this. Microsoft, for instance, has substantial capital distributions to shareholders through dividends and buybacks, but nevertheless maintains a strong balance sheet position. The corporation stated that it had more than $150 billion in cash and short-term assets on hand, as opposed to $50 billion in long-term debt. In a recent report, more than 5% of the market capitalization is currently made up of cash and short-term investments. The enterprise value is $2.4 trillion, or roughly $50 billion less than the market capitalization, according to the net debt. When the profits for the second quarter are revealed, investors should anticipate a capital structure similar to this one. With the market conditions and current valuation, Microsoft's recent decline from all-time highs would be a wonderful opportunity to pick up additional shares. For long-term investors, incremental acquisition can be the best course of action. What about the stock of Tesla then? It is expected that Elon Musk will attend the results call again. Does this suggest good news? Following the release of Tesla's fourth quarter earnings, investors anticipated the return of CEO Elon Musk to the post-results call and prepared for perhaps alarming information regarding the Cybertruck and supply chain issues. Musk stated to Wall Street that until he had something significant to share, he was not likely to participate in any more Tesla earnings calls. In October 2021, he did not attend the third quarter call of the electric vehicle manufacturer. There are rumors that the Cybertruck is even more behind schedule. The truck was supposed to go into production this year and hit volume production in early 2023. It was Tesla's first attempt at a pickup, a vehicle that Americans have liked for decades. When it comes to electric pickup trucks, Tesla is already many months behind schedule and a few years behind General Motors, Ford, and other OEMs, as well as upstarts like Rivian. What does this mean for Tesla then? Should investors anticipate positive news? Tesla's record-breaking fourth quarter sales, which rose by nearly 90 from shocked Wall Street 2020 during the same time frame. All indications point to Tesla, which has put together an amazing run of earnings, having another excellent quarter. Because of the substantial fixed costs associated with auto manufacturing, Tesla's record quarterly production and sales provide them with significant bottom line leverage. Tesla's 2022 guidance. The dates for production ramp-ups at new factories under construction in Texas and Germany, primarily due to supply chain problems and semiconductor shortages, as well as the next phases of its long-term plan to increase production between 2020 and 2030, are all focal points for earnings. Manuel Hosta of Deutsche Bank predicts that Tesla will provide a good update on growth and margin possibilities for 2022, in addition to a schedule of new product and technology debuts, even in the absence of that specific guide. The timing of the production ramp up for Tesla's new facilities in Austin, Texas, and Germany, as well as information about the company's alternative energy sector, the status of its internal battery manufacturer, and sales in China are other potential events to look forward to for the quarter. Alexander Potter, an analyst at Piper Sandler, thinks that Tesla has enough capability to surpass production projections now that the two new factories are operational. However, he thinks Shanghai operations could be in jeopardy because of China's zero COVID policy. By announcing that it delivered more cars than anticipated in 2021, Tesla got off to a positive start in 2022. Thus, there's no reason why it can't have an outstanding year going forward. Because of its cutting-edge technology and devoted customer base, Tesla is the most significant participant in this sector and will inevitably profit from the growth of the business. Comments in. What are your thoughts on Jim Cramer's analysis of Tesla stock? Please leave a comment below.